Well, global markets remain near their highs, but there are a lot of mounting tests for the share prices to face. So hi there everyone, welcome to the Traders Circle Weekly Market Update. Today is Tuesday the 11th of February 2025, but before I get started, you do need to be aware that whatever I say is general advice only, and you have to consider whether it's appropriate for you. So, tariffs. Tariffs have been a big test for markets recently. Obviously, US President Trump has come in, he's announced tariffs. Some of them he's pulled back, some of them he's placed. Initially, the market's response was quite negative. We saw selling in the US market and indeed our own market when tariffs were placed on Canada and Mexico. But he very quickly unwound, or at least paused, those tariffs after he made deals with Mexico and Canada. Markets bought back up. And after that, markets haven't really responded too negatively to subsequent tariff announcements. And I suspect that's because they're not sure they're going to remain in place. They think Trump will make deals. He'll basically pause or unwind those tariffs after he gets what he wants. I do think that's a little bit short-sighted by markets, however. I don't think there's clear signs that he will unwind some of these tariffs he's placed. And I'm specifically talking about the tariffs on China and the tariffs on steel and aluminium, and potentially tonight or tomorrow night some reciprocal tariffs that he's looking to place to his perceived enemies around the world. I also think that there's a real potential for tariffs on European trade, and again, I'm not sure he's going to be very quick to unwind those. Tariffs are not good for economic activity, they're not good for company earnings, and they're not good for share prices. We've seen that throughout human history, and most notably during the last Trump presidency. So if he does place tariffs, you have to assume there will be some negative effect. It might not be immediately, and that's because markets are so unbelievably bullish, but it will have some effect when company earnings rolls around, when economic data rolls around, and the effects of those tariffs are seen in the numbers. I think it was Jesse Livermore, a famous investor, who once wrote, in the short term, markets are voting machines, and obviously everyone's voting bullish, and they have done since November 23. But in the long run, markets are weighing machines, and if you do start adding in things like tariffs, it tips the scales against share prices. The big tests for Australian markets this month and this week in particular are company earnings reports. We've seen several large companies report earnings, but perhaps the most important report will actually come with CBA's report tomorrow morning. So far we've seen things like JB Hi-Fi report earnings, we've seen CSL report earnings, and perhaps some smaller names as well. JB Hi-Fi fell on its earnings numbers despite some pretty good numbers, and I suspect that's because the share price was unbelievably high. JB Hi-Fi is trading up around $100 per share, and yes, it did achieve good numbers, but it achieved great numbers when it was trading around $40, $45 per share. The market was unwilling to pay 15 times earnings back then, but they're willing to pay almost twice that now, which is quite unbelievable. So no surprise that even after some good numbers, JB Hi-Fi saw a little bit of selling. CSL also reported today, and they dropped about 5%. Their numbers looked fairly decent, but again, it struggles to justify fairly high share prices. We'll see CBA's report tomorrow, and this will be perhaps the most important earnings report for the Australian market, since their last report in August. CBA is trading at a higher earnings multiple than CSL. Its dividend yield is now barely above CSL's report as well, and their earnings growth is likely to be quite a bit less. I think, much has been written about CBA being perhaps the most expensive bank on earth, perhaps the most overpriced bank on earth. It is trading at a dividend yield below the Australian government bond rate. It's trading at an earnings multiple almost 3 times that of, say, banks in the US or in Europe. And so, it's dragged the whole banking space up with it. ANZ, NAB, Westpac, they're all trading at very expensive levels. And I suspect a lot of that is just they've been dragged higher by the strength in CBA. So CBA's report really does risk, I guess, a bit of reality crashing back down to the market. If the report is worse than expected, I do think we'll see selling across the other big 4 banks as well, and there is a lot of room to the downside should the valuation return to a bit more normal levels. Regardless though, it's impossible to say what's going to happen. We're going to know the results tomorrow morning, and we'll see a response from the market pretty much immediately. After CBA's report, there will be a bunch of other reports for the next 2 weeks, and with the market at pretty much the highest levels it's ever been, both from an actual level and a valuations perspective, I do think there's a bit of risk to the downside here. Keep in mind that our market is probably going to earn less this year than it did 2 years ago in 2022, and yet our share prices are 20% higher. We're 1,000 to 2,000 points higher than we were back then, despite lower earnings, despite lower dividends. While those earnings might not matter when there is so much liquidity coming into the market, it does create the risk for a short-term shock to the downside. Finally, I wanted to talk about inflation and interest rates. So tomorrow night, Wednesday night, Australian time, we're going to see US inflation numbers. They are expected to tick up from where they were in December. So the January inflation is expected to grow by about 0.3%, up from 0.2% in December. That's before the effects of things like tariffs will be kicking in and lifting prices. And so, it does create a bit of discussion in the market about how likely we are to see further US rate cuts. This reading will probably determine the timing of the next US rate cut, whether they continue to hold or whether they resume cutting rates. If it is 0.3% or greater, it's hard to see a case for cutting interest rates. Like I said, that's inflation ticking up from December. Annualized, that's well above the Fed's target range. And so, it could cause a bit of a continued pause from the Fed. After those inflation numbers come out on Wednesday night, we will see a speech from Fed Chair Jerome Powell, and no doubt we'll also get commentary on it from US President Trump. We're also expecting an Australian rate cut next week. In fact, the market's pretty much completely priced it in. It seems like everyone in the financial markets in Australia are saying, we're going to get a rate cut next week. That's it. We're going to start the cutting cycle. The RBA is going to cut from that point onwards. We'll see a federal election called on the back of it, and obviously our market's holding up into that announcement as well because they're also expecting a rate cut. I don't think it's quite as certain as the market is saying that it is. I don't think it's the 100% guarantee that everyone thinks it is. Obviously, our inflation has come down pretty much to the target range, but the RBA has been a little bit more sanguine in terms of, guaranteeing that we're going to get a rate cut when the numbers have come out as they have. Keep in mind, they did say they wanted to see 2 positive data points before cutting rates, and you could argue that we've only really seen that 1 positive inflation read to justify the supposed rate cut next week. Regardless, I still think it's the most likely outcome that we will see that rate cut, but I don't think it's the 100% guarantee that the market thinks it is. Even if we do get the rate cut, I'm not 100% certain that it will be quite as bullish as everyone's been hoping for. And the reason that I say that is because even if the RBA does cut interest rates, I don't think they're going to be quite as dovish in their accompanying statement. I think they're going to basically say, yes, we're cutting rates now, but we're going to sort of wait to see how things pan out after that before committing to further rate cuts. I don't think it's just going to be, we're turning the tap back on sort of thing. That's going to be next Wednesday, I believe. Apologies, I believe it might be next Tuesday. Most likely they will cut rates 2:30 p.m. next Tuesday. So let's have a look at the charts for this week, guys. And we'll start with our market, the XJO. We tried again at that sort of 85.20 level today, and we failed. We pulled right back. And that came with some selling in overseas futures markets. It came with some selling in the Asian region. And we basically returned to where we closed yesterday. Overall, we are in a big ascending triangle, but we do look to find some sort of sticking points up here, right around 85, 85.50. Again, these are the highest levels we've ever been. This is the most expensive on a mathematical basis that our market's ever been, and the outlook isn't that positive. Yes, we've got potential rate cuts, but it's not like earnings growth is forecast to be the strongest it's ever been. Earnings are pretty poor compared to where they've been recently. Dividends aren't going to be that great either. So I do think there's a bit of room to the downside if we see reality strike markets, any point in the near term. should we break above 85, 85.50, it's likely that our next peak won't be too far beyond the current levels. If we do come off from here, the first target to the downside would be the recent support at roughly 83.70, and then if that breaks, we've got the longer term uptrend line, and that might come in around 8300 when we get there. So let's have a look at the US market. And this is the US S&P 500, and obviously it looks eerily similar to our own market. The reality is it is US liquidity, US government borrowing, or, if you will, US money printing that is driving Western markets higher. And so it's no surprise that our market looks very similar to their market. They've got resistance at 6100, and they've got the longer term uptrend line just below the current level as well. So they're also in an ascending triangle. If they can break through that resistance, roughly 6120, I don't think the subsequent high is going to be too much beyond that level. I think it's going to be an incremental peak. If they pull back, they do have a bit of a level at 6,000, but I suspect they'll head towards the longer term uptrend line and then decide where to go from there. Their market is also very expensive, and there is a lot of risk to the downside if valuations normalize. But I will just caveat that by saying the US government is running a deficit of $2 trillion a year, maybe more, maybe a little bit less if they can contain spending, but I don't think they will. And when they are running such a large deficit, that's essentially new money they're creating and pumping into the market. So that money has to go somewhere, and we're seeing it push up share prices. We're seeing it push valuations to extreme levels. We're seeing things like gold rocket. Bitcoin is gone to obviously absolutely monumental levels. And so all of these risk assets are being pushed up by that liquidity. You have to assume that will continue, but there are risks of short-term spikes to the downside. If we ever see US government spending normalize, so they basically run a neutral budget, Mike's laughing because I think it's very unlikely, we will see the market collapse. And even though that might be unlikely, perhaps a more likely scenario is that we see a runaway debt cycle there, which they'll have to address, and that's also a big risk to the market. But regardless, markets are holding their highs, and that's despite a bunch of negative data. And if we do see more negative data, there are risks of spikes to the downside. But the likelihood is, as long as that liquidity tap is on full blast, things are going to keep pushing sideways to higher. So we'll wrap it up there for this week, guys. Hopefully you enjoyed. If you did, click like, click subscribe, and we'll see you guys next time.